Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Tuesday, July 21st, 2026, and we've got a packed show this morning. Big tech earnings week is officially underway with Alphabet, Tesla, and Intel all on deck. The semiconductor sector is in bear market territory. Bitcoin is stuck near $64,000 with regulatory headwinds building, and we've got initial jobless claims coming Thursday ahead of the Fed's July 29th decision. Let's get straight into it. Lizzie, futures are pointing higher this morning with Nasdaq leading the charge, but we just came off the worst week of the quarter for chips. What's the mood heading into this earnings week?
Morning, Robert. The mood is cautiously optimistic, but with a real undercurrent of anxiety. Nasdaq futures are up around 0.5 to 0.7%, but traders haven't forgotten that last week the Nasdaq dropped nearly 3% and the Philadelphia Semiconductor Index officially entered bear market territory, down more than 20% from its June peak. The rally in futures this morning feels more like a relief bounce and dip buying than genuine conviction, and everything hinges on what Alphabet, Tesla and Intel actually deliver this week, in terms of earnings and, critically, their forward guidance on AI monetization.
This week is essentially a referendum on the AI trade. Which of those names carries the most weight for the broader market right now?
Alphabet is the one to watch most closely, not just for earnings, but for capital expenditure guidance. Because the entire market narrative around AI spending gets validated or questioned by what Google says about its data center and infrastructure commitments. Tesla matters for consumer sentiment and execution, and Intel is the canary in the coal mine for the chip sector's near-term health. But Alphabet's AI monetization story is the clearest test of whether the 2026 rally has real earnings behind it or is running purely on hope.
TSMC reported a 77% profit jump and still fell. Samsung posted a 19-fold increase in operating profit and also dropped. What does that tell traders about how the market is pricing chip earnings right now?
It tells you that expectations have been priced to perfection and the bar has moved. Beating earnings is no longer enough. You need to beat and raise guidance while simultaneously convincing the market that AI demand is durable and not being commoditized away by cheaper models. When TSMC reports the kind of numbers it did and the stock still sells off, that's the market saying it's worried about the forward picture rather than the past quarter. And with Moonshot AI's Kimi K3 model rattling assumptions about AI scarcity, traders are repricing what semiconductor revenue looks like in a world where cutting-edge AI becomes widely accessible.
The SOXX ETF is now over 20% off its June peak, and Ed Yardeni is warning it could fall another 12% to its 200-day moving average. Is this a sector in genuine distress or a buying opportunity?
Yardeni's caution is well-founded. When you combine margin calls on South Korean chipmakers, AI commoditization fears from Kimi K3, and leveraged retail options activity, amplifying every down move, that's not a technical dip. That's a structural reassessment, and his move to market weight on information technology back in December 2025 looks prescient right now. That said, S&P 500 semiconductor companies are still forecast to post 130% earnings growth in Q2 and contribute nearly 44% of overall S&P 500 earnings gains, so the fundamental case hasn't collapsed. But traders need to see credible AI monetization from this earnings week before stepping in with real conviction.
Switching to the geopolitical picture. Brent crude is elevated on Iran tensions, oil majors are catching a bid, and Lockheed Martin popped on new defense systems. How are traders positioning around Middle East risk?
The energy trade is fairly straightforward right now. Oxy, XOM, and CVX are all seeing buying interest as long as Brent stays elevated on Strait of Hormuz concerns. And Lockheed's move after announcing counter-drone and missile defense systems reflects a broader defense sector rotation that tends to happen when geopolitical risk escalates. The more important point is that rising oil prices are reintroducing inflation concerns that the market had been getting comfortable fading. And that creates a headwind for rate-sensitive sectors, while complicating the Fed's calculus heading into July 29th.
Warren Buffett is sitting on nearly $400 billion in cash, underperforming the S&P by over 11 points this year and calling the market a casino. Does the data actually back him up?
The data gives him a reasonable argument. VTI's trailing PE is around 28 times earnings. The earnings yield on equities sits below the 10-year Treasury yield of roughly 4.5 to 4.6%, and when risk-free money pays you more than the equity risk premium, Buffett's caution isn't irrational. But the momentum has been punishing for value discipline in 2026, and Berkshire's minus 1.4% versus the S&P's plus 10% tells you that being right in principle and being right in timing are two very different things. The market can run on speculation longer than fundamental discipline can stay solvent in relative performance terms.
Steve, let's get the macro picture. The key release this week is initial jobless claims on Thursday. The forecast is 212,000 against a prior reading of 208,000, which itself came in well below expectations. What are you watching for in that print with the Fed decision just 8 days away?
That last reading was genuinely notable. Claims came in at 208,000 for the observation period, covering the week ending July 12th. Well below the consensus forecast of 217,000 and down from 216,000 the prior period, which signals the labor market is holding firmer than most economists expected at this stage of the cycle. Thursday's release, covering the week ending July 19th, is forecast to tick up modestly to 212,000, and what I'm watching for is whether that prior beat was a one-off or the beginning of a sustained trend, because a second consecutive sub-215,000 print would reinforce the Fed's view that the labor market doesn't yet need emergency support and gives them cover to hold on July 29th.
And how much does a single claims number actually move the needle for the Fed, given everything happening with oil and inflation?
Honestly, one claims print won't be decisive on its own. The Fed is weighing a much more complex picture that includes headline CPI running at 3.8% annually after a softer monthly reading, Brent crude elevated on Iran tensions, and European natural gas up over 90% year to date, all of which carry imported inflation risk that could push price pressures back up in the coming months. Futures markets are currently pricing a 75 to 80% probability that the Fed holds rates at 3.5 to 3.7% on July 29th, and unless Thursday's claims number shows a dramatic deterioration in the labor market, that hold scenario looks firmly in place. The bigger risk is that energy prices force the Fed to stay on hold longer than markets are currently hoping.
Lizzie, over to crypto. Bitcoin is range-bound near $64,000 to $65,000, down nearly 27% year-to-date and well off its October peak above $126,000. What's keeping it pinned here?
The dominant force capping Bitcoin right now is the regulatory ceiling. Polymarket odds of the Clarity Act passing by year-end have collapsed from 82% in February down to just 32%, and without a clear legislative framework dividing digital asset oversight between the SEC and the CFTC, institutional capital is staying cautious. Bitcoin ETFs did break an 8-week outflow streak with $273 million in inflows over 2 weeks, which is technically positive, but analysts are right to call that figure modest relative to the over $8 billion that left during the prior stretch, and $65,000 remains the key technical resistance level, with a potential short squeeze towards $67,000 if that level breaks convincingly.
Ethereum dropped 2.7% on the Clarity Act news, but Tom Lee is comparing ETH to Amazon before AWS and Nvidia before the AI boom, and Morgan Stanley looks close to launching spot ETH and SOL ETFs. Is there a genuine bull case building here?
There is a credible structural bull case for Ethereum. Wall Street is actively building financial infrastructure on the network, with BlackRock, JP Morgan, Coinbase, and Robinhood all running tokenization initiatives, and Morgan Stanley's pending spot ETH and SOL ETFs under tickers MSSE and MSOL at a competitive 0.4% fee would meaningfully expand institutional access. Ethereum did outperform Bitcoin last week, jumping roughly 7% over 5 days compared to Bitcoin's 2%, which Fundstrat's Sean Farrell flagged as historically significant, because ETH led the broader crypto recovery during the 2022 bear market as well. But near term, ETH sitting around 1,837 talons still faces heavy regulatory headwinds, and the Clarity Act timeline remains the single biggest variable between a continuation of this bounce and another leg lower. Solana is also worth watching here, given DeFi developments reporting of a record 3.8 billion transactions on the network in June, which speaks to genuine on-chain activity rather than purely speculative positioning.
That wraps up today's Morning Bell. Remember, this is not investment advice. Do your own research. And don't forget to subscribe so you never miss a morning. See you tomorrow.